Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Jay Martin, who's the host of the Jay Martin Show and president of Cambridge House International. So, Jay, thanks for joining the podcast today.
I'm happy to be here, Anthony. Looking forward to it, man.
Yeah, definitely. I'm sure we'll get onto some interesting topics. So, I was just wondering if you could explain a little bit more about, I guess, how you've got into this stage, I guess what influenced you to do sort of the show, and I guess to learn more about investing in the macro in general.
Yeah, certainly. I kind of stumbled onto it after a decade of adventuring and gallivanting around the world, and came to a point where I decided that I loved adventure, but I wanted to learn how to make money. And so that brought me back to Vancouver, British Columbia, where I grew up, and which is kind of the center hub for precious metals investing in terms of financing junior mining companies. They explore all over the world, but about 60% of the companies that are exploring for those minerals raise money in Vancouver. And so that was where I ended up cutting my teeth as an investor. The podcast started in the spring of 2020, and this was launched in response to the sky falling everywhere, and every day us waking up to new shattering headlines that normally would have stopped the presses on their own. But at that point in time, spring of 2020, it was like a new one every single day. And, I'd been an investor for about 12 years at that point. I'd run investment conferences all over the world. And I knew that it was moments like this that really give you the opportunity to change your life, right? If you can figure out the puzzle during those moments, that's when you can really change your life. And my investment conference company, being in the event business, was just getting shut down, right? The live event business was not doing too hot. And a mentor of mine called me and said, "You may not understand this, but this is the opportunity of your lifetime." And I was like, "What are you talking about?" Like, I felt like I was going bankrupt. What do you mean? And he said, "Look," he's like, "your business just got shut off overnight, completely out of your control, nothing that you did, and it's nothing you can do to stop this. If you can figure this puzzle out and come out on top, you're going to feel like the king of the world. So get your shit together and get to work," right? And I needed that kick in the butt at that moment. What I decided to do was leverage the hundreds of keynote speakers we'd had at our conferences over the years, bring them into this conversation format with the intention for myself to figure out the smartest home for my cash. Getting back to that, this is the moment to make or break investors. I was like, well, what I'm going to do is find out what all the smart money I've met over the last decade is doing right now. Where are they putting cash right now? And I'll have 3 or 4 of them on an interview every single week until I know where every dollar is going. And then, because everyone's got their own risk tolerance, time horizon, asset preference. There's no correct strategy, but what you can do is gather as many as humanly possible and then craft your own based on your risk tolerance, available capital, time horizon, all of that stuff. It started as a very self-serving initiative just for that reason. I was looking for the smartest home for my cash and to stress test my theses, right? Like if I was excited about something, I think this is a good direction to be looking to allocate some dough right now. I could have a few guests on the show and say, "What do you think?" And they could say, "Oh, you're right on the money, but you're 10 years too early." Or, I think I'm thinking the same thing. Or, "No, you're missing a huge blind spot and here's what it is." And so it allowed me to stress test all my thinking like that. It's evolved into just sort of the retail investors channel, right? Anybody who's on the same mission that I am as a retail investor looking for the smartest home for their cash. I mean, that's who watches my stuff because my viewers are retail investors just like I am. I'm not a full-time investor. I run 2 businesses. I got 3 kids. I can't be a full-time investor. I don't have the time. Having said that, I know how wealth is created. It's capital gains, not salaries. And that's definitely a laser focus point of mine.
Yeah, I think that's the same thing. And I think sometimes what people resonate with is we're both on the same journey of like trying to figure this, as you said, figure that puzzle out. Because especially at the moment, it feels like things are changing. There's all these things happening in the background. It's like, hang on, how do we look at these things and then from there, as you said, invest and hopefully get those capital gains in the next 10 years?
Yeah. Yeah. And
Yeah.
determining what kind of investor you are is pretty crucial in that moment, right? And we've seen this surge over the last 24, 36 months of interest in the markets and on the back of all kinds of meme stocks and goofiness, and it's encouraging, I think, that people are turning their focus towards the markets to say, look, I understand this is where money is made, and this is not stuff you're taught in the education system. So I love that we're seeing this new surge and generation of retail investors turning their eyes that direction. The question I think that often is not asked, that is hyper important, is what kind of investor are you? And it might be the most important question. And you don't just know, you have to carve that out of marble. Like it takes, but an important question you should answer in order to get closer is, how much time do you have to invest in being an investor? Because if it's like 2 hours a day, don't try to be a day trader. And I see too many people doing that, right? Where they're trying to enter this game of timing markets, but they're trying to do it with 120 minutes a day. Even if you have 4 hours, look, that's a really, really tough game. And so determining how much time you have to invest in being an investor gives you a clue into what kind of investor you should try to be.
So what type of investor would you be? I guess are you more not passive, but I guess you have this sort of direction, but then it might not be as much about the specific timing of it. Or yeah,
Yeah, I'm a value investor. I
yep.
look for value. I look to allocate capital, and I look to hold positions for anywhere between 1 to 10 years. And depending on the industry and the size and stage of the company, that will determine a few things. But I am not smart enough to time any markets. I think that's a bit of a mug's game. You can get lucky, absolutely, and feel on top of the world, and then see if you can do that 3 times in a row, though. That's my challenge to you. What we can do effectively, though, is step back from the near-term noise, which can be very confusing and often misleading. The day-to-day headlines are generally bad for you. It's bad for your investor diet, because it's like every day the direction of the winds has seemingly changed, and we know that's not possible. But if you can step back and look at what's the 5-10 year trajectory of some things here, and from there we can craft a bit of a narrative and a thesis that you can build some confidence behind and say, okay, so if we're thinking this way about the energy sector, what do we think that's going to do to the price of the ingredients of the energy sector? And if so, right, where can we look for opportunities there? I adopt the barbell approach with my portfolio. So it's like super stable, reserved, boring assets on this side, that what they purchase me is a sound night's sleep. Very, very important. And then on this side is the highly speculative, early stage, high risk, where I have a ton of fun. That's where the capital gains are made. And when they're made, they're peeled out and put over on the stable side of the barbell. And, rule number one as a speculative value investor is stay alive. So whatever's on this speculative side, you can afford to lose it because of whatever's on the stable side, whatever's in the war chest, right? And from there you can go speculating, which can be tons of fun. And it's a lot of work, but it's tons of fun.
Yeah, it's interesting. And what's your time horizon for your investments, or does it change?
Well, it's typically around 3 to 5 years, but as I said, it could be as short as a year, as long as, and there's definitely things I own, Anthony, like my physical gold, for example. What's my time horizon on that? It's infinite, because my intention is to leave it to my kids. And that may not, there's very few times in history when you actually want to own gold, right? But during those times, it's about the only thing that you want to own. And so if one of those times occurs during my lifetime, then maybe I'll need it. But the intention is, this is something I'll leave to my children. And so the time horizon is infinite. Right now I'm looking at a couple early stage energy companies, and it's the early stage enough that if we get lucky on timing, sometimes you can see a massive surge in price in a short period of time, and we realize a capital gain sooner than you expected. And I never hesitate to take profits in those scenarios, right? Definitely let your principal ride, maybe. So should never say definitely, but a lot of that's determined, I suppose, by how things perform. But when I make a bet, I'm comfortable allocating that capital, typically for about 3 to 5 years.
Yeah, it's really interesting. So, you mentioned that puzzle before, and I guess you could link that a lot to the macroeconomic landscape of where you think maybe the next 5 years is going to go. So, I guess in your perspective, what are the major trends that you're really watching, and I guess potentially is that influencing the investments that you're making?
Yeah, I'm very curious about the energy sector. I think that there's been a lot of conversation around the energy crisis in Europe, and the majority of that conversation has been focused on this winter, getting back to like how we tend to gravitate towards super near term thinking. A lot of the questions that have been asked are, how will, will Germany, rethink their alliances in exchange for cheap energy from Russia this winter? How will they survive this winter? As if they survive this winter, everything's resolved, and the world is not that simple. My thoughts on that, it was sort of the most common question in macro, it seemed about 2 months ago, was what's Germany going to do, right? They're going to have to make a choice between their moral stance on this war and heating the homes of their population. And there seemed to be very low confidence that they were going to be able to keep that moral stance, and they were going to choose Russian cheap gas for their population. And it was one call I definitely did not agree with. I think when you focus the attention of a population on one sort of shared enemy, you could say, Russia's leveraging or weaponizing source of energy over a population like that, it often unifies and unites the people, not divides. And you look at what happened during London during the Blitz, right? The idea there was to not destroy the city of London, it was to destroy the morale of the people so that they would petition Churchill to surrender to Germany, right? That was the intention behind the Blitz. It wasn't to destroy the city, it was to destroy the morale, but the opposite happened. It focused the people's energy on one central enemy and said, fuck this, we're not going down. We're way tougher than you think we are. And they maintained life far more normally than anybody would have ever expected. And still, it's still hard to believe. And I think Germany's in this, didn't end up in a similar situation, but it might have, right? The winter's been milder. They were able to replenish their reserves a lot more than anybody thought. But I'm watching the energy landscape very close right now and playing that, looking for opportunities and specifically natural gas exploration in that part of the world. I think everyone's looking towards renewable to solve their immediate energy needs, and renewable one day, but nothing about renewable is immediate. And so I'm looking at the natural gas sector in Europe for sure. I'm also looking at the precious metals sector, specifically the gold industry, and I'm looking at, what I would say is multi-asset dividend-paying gold producers. And the reason for that is that if I were to make any calls on how the rest of this decade is going to go, I would say that the 2020s are probably going to be how the 2020s have been, which is just this continued, unprecedented, unpredictable chaos and volatility. And I do think that party is just getting started. I don't think we're near the end of it. I think there's a lot to be shaken out in this, new era of distrust that we are now entering, right? And what I mean by that is, for my entire lifetime, the world's operated in some semblance of fragile trust, but enough so that we could access cheap labor from China, cheap energy from Russia, cheap cash from the US, and the whole world could coordinate and produce goods at cheaper and cheaper cost because you had access to the world market of anything that you wanted, and you could just hunt the cheapest prices. But that era is over, and I don't believe it's going to come back probably in my lifetime, but it'll take at least the next 8-10 years to sort itself out what this deglobalization trend is really going to look like, as we repatriate industries and all this stuff. Anyways, what do you do in that scenario when the only certainty is uncertainty? Well, you look at what central banks are doing, because they often lead the way and they're setting records on gold purchases and repatriating the gold they own. Countries like Germany, who have owned a lot of gold but stored it in the United States because Europe always descends into war with frequency. It's a lot of nations on one continent. It's inevitable. And so they intentionally store their gold offshore, and they're now repatriating that. They'd rather have it within their borders while a hot war is occurring not far away than have it overseas. They want fingers on it, right? And we're seeing record, I think it was 400 tons purchased in Q3 by central banks of gold. And there's two sides of a transaction. So what was sold to buy the gold, often it's US treasuries. And that's a big shift for central bank thinking. And so, I am following that shift myself, and I've increased my physical gold holdings, but also my exposure to both gold producers, gold royalty companies, and because I like to gamble, gold explorers. But that's a risky bet down there. Yeah.
Yeah, no, that's fascinating. As you said there, it's almost the perfect time to have like, the next decade will be very volatile. The perfect time to have that barbell approach of having, rather than, I guess, the last 10 years, the best performers have been the ones who basically just went the S&P 500 or very high beta stocks. If you have this barbell approach, then probably going to do better to protect your wealth through this volatile time.
I think so. I think so. And the way I think about it is like, what am I really trying to purchase here? And I'm trying to purchase a good night's sleep at the end of the day. It sucks being stressed about what tomorrow might look like. And how do you solve that, right? There's that idea that I call financial confidence. I tend to think about that more than financial independence or financial freedom or all these things that, are important for sure. But the reason I resonate more with financial confidence is because, what do you need to feel confident, and how do you act when you feel confident, right? And I think, well, physically, if you feel physically confident, it means you got some tools in the arsenal, and maybe you're comfortable, just hanging out by yourself, walking down the dark street, whatever that is. But most importantly, it's because when faced with a crisis, you have this option to stand there and do nothing. You're probably going to be okay and just to wait this out, because whatever happens, you're probably built for it, right? When you don't have that confidence, you tend to react short-term thinking, you do things you regret, you make mistakes. Finances are no different. We're all going to be hit with crises, and you're either going to be prepared for it and know you have the option to sit, wait, and do nothing, or you're going to feel like, holy crap, I'm overexposed, over leveraged, I've got to react and do something quick. And then you're moving fast, you're more likely to make mistakes, you're operating from a place of scarcity and reactivity, and it's not healthy, as opposed to just being proactive, like I was fortunate enough to feel in the spring of 2020. Like, look, if I can just sit here, be patient, I know these are opportunities that can change people's lives. And so let's get into this, right? And that's how you want to feel. And that's behind the barbell approach. It gives you that patience card. And you pay dearly for it, but it's absolutely worth it, because the returns are a good night's sleep. Yeah.
Yeah, definitely, and wealth protection. So if we go back to the energy, because that's something that's been really interesting, as you said, the winter was mild, but as someone in the UK, it started snowing. I think it was -4, and some places -15. So it feels like it's gone to that point where, unfortunately, we've gotten the cold. There's not much wind as well, which has really reduced that, turbine production, and has increased the spot prices in the UK and I think the rest of Europe quite a lot. So in terms of how you're playing that, you mentioned sort of, was it contract, I guess futures contracts and natural gas, or are you looking at equities? Are you looking at maybe potential for next year? Because there's concern that 2023 winter is going to potentially be worse. How are you doing that?
Yeah. So no, I don't look at futures contracts, not for any negative reason. It's just I look at equities, and specifically exploration development companies, because I have a competitive advantage there, because I spend all my time there. And I guess and I think everybody should do this. If you're looking at allocating capital and you can't decide, like, what's my competitive advantage, what's going to put me ahead of the herd, if you can't answer that question, I think you should think pretty critically about what you're doing there. And passive investing, that's a different story. But anyway, so I stick to the equities because I spend time there, because I have 3 money managers or entrepreneurs on the show every week. I have resurrected my conference business. We're back in business and host one of the largest investment conferences in the commodities business in North America. And I've got a good finger on the pulse of where capital is going, and why, and who to invest in. Most importantly, it's often when you get into the early stage, exploration companies. For example, I'm looking at a natural gas exploration company in Europe right now, and it's all about the who for me. It's who's on the board, who's leading the team, and why should I let them have an adventure with my money, right? Why should I trust their decision making and their ability to surround themselves with other great people? Now, the energy sector's got a lot going on right now, and the renewable narrative is really, really hot. And I think it's mistaken and incorrect and a bit of a misnomer. And we can get into that, but it doesn't matter, because the world's going to chase that down, and they're going to go that direction. And as we continue to electrify our planet, whether that's just cars, whether that's larger battery storage to try to find a way to make things like solar and wind baseload equivalent, I'll bet all day long on human ingenuity. We will solve that one day. I think it's going to take far more minerals than people realize. But whatever direction you look, when you go towards electrification, you do need a few things. And one of them's copper, and another one's nickel. And the reason I like those two in the renewable sector is just because they're the most fundamental metals required. Cobalt, lithium, also in super high demand, but more volatile in terms of how they can be engineered in and out of a lot of these technologies. Whereas there's no better conductor than copper, right? And you're not getting rid of that one, and I've seen the cobalt sector pull a fast one on investors before because it's hard to get. A lot of it comes from the Congo, not a great place. A lot of it is hard to access in China, and there's very few places elsewhere that you can find it. And so, what entrepreneurs end up doing, and we saw this with the Tesla battery, was they just engineered it out of the equation and it was no longer required. So the market kind of dried up, right? Lithium is sort of similar, but in the opposite sense, it's quite abundant within the earth. And so it's not super hard to find. There's lots of it, which does throw a wrench in a lot of the supply and demand forecasts. And that'll change over time. But because I don't feel confident in my ability to predict those changes, I would never bet as big on them. And if and when I do, it's with a really sound management team who's got a track record of success and tons of skin in the game. But in the energy sector right now, I'm looking at natural gas. I am quite exposed to copper and nickel. And I like the royalty companies specifically when I'm looking at those, just because the miners right now are exposed to the same inflation of their input costs that we all are. And I don't expect those to come down in the near future. And so that will put a bit of weight on the margins, but the royalty companies are protected from those input costs. That's their advantage, right? So a little bit less volatility, but some insurance against inflated input costs. And those are a couple directions that I'm looking at right now.
Yeah, it's really interesting. So, what geographies are these companies in? And I guess area and other countries maybe that you're watching, but you haven't essentially invested in.
Yeah, so I think right now, in terms of like weighing geopolitical risk, and it's a more important question than it used to be. And that's because, as I said, I think we're entering a new era of distrust. And so if you look at the exploration business, where minerals have come from over the last 20 years, a lot of the most lucrative investments were made in the least understood and most volatile and unpredictable countries. And that's because exploration hadn't occurred and there was tons of resources that hadn't been tapped and lots of upside. But I think we're going to continue seeing an increased trend of when discoveries are made in unpredictable nations with more questionable rules of governance, and we're going to continue to see an increase in the nationalization of assets as they're discovered. And so I'm really doing my best to let myself only be exposed to countries that are on friendly terms with the West. And the only reason for that is that there's a slightly higher percentage that you're not going to run into super taxes on newly discovered assets, nationalization of newly discovered assets or existing assets, some that suddenly become more profitable. And, I would just say, look towards predictability of government. And you can criticize, the Canadian and American government all day and say there's corruption and there's unpredictability. And, look at the confiscation of financial assets in both countries over the last 18 months. It raises some eyebrows, but you have to always ask relative to what? Like, what are my other options here? Where else can you go in the world, right? And I'm a hard critic of our federal leadership in Canada, but relative to most anywhere else on the planet, it's still predictable. And as an investor, what you want is predictability in terms of how government will allow resources to be extracted, exported, and taxed. And if you don't have confidence in that formula, then you can still make the bet. It's just a little bit riskier and you should pay a discount for it.
Yeah, definitely. So, which countries? I don't know if you want to say these are.
Yeah, so here's what I'm quite exposed to Peru right now, both for silver investments and copper investments. And I'll bring this up because based on what I just said, you could say, talk about unpredictable. Like the country's had 5 presidents in the last 6 years, right? So what's going on there? But you look at the country's 20-year track record of how it's handled mineral exploration companies and development companies, and it gives me all the confidence in the world. And so I've got exposure to one silver producer and one silver explorer, and via a royalty company, I've got exposure to a couple copper producing companies in Peru. I like Mexico. I've had success in Argentina and Chile. I'm exposed to the gold sector in Nevada and Idaho in the United States. I still like Canadian exposure, and I just think you have to look on a province by province basis. I would probably stay out of British Columbia, for example. I like Alberta, Saskatchewan, and Quebec. I like certain parts of Ontario. Um, but historically speaking, those are a few countries that I'm exposed to right now.
Yeah, that's super interesting. So I guess from your perspective, you're seeing that is the gold play as well. As you said, there's times in history where it's going to be very valuable and it's going to hold up a lot more compared to other assets. Are you concerned potentially there's lots of people talking about, I guess, hyperinflation, but also at the same time the potential recession and the impact that will have on financial markets and banks in general? Are you sort of looking at it from that perspective as well, or is it more just the fact that it's a good asset to hold as a part of a portfolio?
No, I think that factors in massively and gets back to not just my motivation, but why our central banks, institutions, and retail investors like myself curiously increasing their physical gold holdings. It's exactly that. We saw massive discretionary inflation over the last couple of years, and now massive necessity inflation, right? Food and fuel. Now, maybe peak inflation has occurred. I don't know. I can't predict that, but we're not going back to 2%. I would predict that, and so if the number stops going up, that doesn't mean it's going back to where it was 18 months ago. Those are two different things. And yeah, I think that we'll have to wait and see like what happens to European economies and European industries with new energy prices. A lot of them will become unsustainable. And I don't fall into some hyperinflation camp. I don't think it's likely. And in fact, I think, if you look at any industry that innovation or tech has touched in the last 15 years, they become massively deflationary really, really quickly. And we're going to continue to see more of that. So there's not just one force at play here. It's not just an inflationary narrative. There's deflation all around us as well. And I think that will continue to spread just as rapidly. But it gets back to like, how will the remainder of this decade be, right? Massive coordinated global recession? Yeah, possibly. Massive hyperinflation spreading throughout the world, starting with emerging economies, leading to developed ones. Like, yeah, maybe, right? Will the hot wars spread? Maybe. Like all these maybes, but they're all quite dramatic and consequential. And so not knowing, like acknowledging that you can't know how those will unfold. You can't. There's lots of people that will claim they can, but be wary. Where do you go in those scenarios? You go to a boring asset, right? I have good friends who own a little bit of gold and they don't get it, right? Here's the thing. Here's the weird thing about gold is that you own a little bit of it and people assume you're some tinfoil hat gold bug, right? Whereas you own a bit of real estate, no one's calling you a real estate bug, or cash, no one's calling you a cash bug. But there's a bit of a disconnect. And, I have a good friend the other day, he bought a kilogram bar of gold a while back. He wanted to diversify a little bit. And he was so upset that it had done nothing, in his words, compared to his crypto and his equities and even his real estate. And, I had to push back and say, that's the point of a safe haven. It doesn't do much, right? Like you can find volatility elsewhere, but imagine if the safe haven asset was as volatile as Bitcoin. Like what would that do for you in a point of crisis? You'd never know, right? It would move very quickly in one direction or the other. So how does that give you some security and stability, right? Which is the point of a safe harbor.
Yeah, I think with gold as well, it's really been based on the strength of the US dollar. Like if you compare it to other currencies like the Australian dollar, I'm not sure about Canadian, but just other currencies in general has actually performed quite well, definitely the yen, and over the past year or so. So it's just been a strength of the US dollar and relatively to other currencies, which is why maybe gold hasn't performed as well as other assets.
Yeah, it's a US dollar story, and that's exactly it. Again, relative to what, right? When people say gold hasn't done much in the last, so look, we've had a hot war, we're having, crazy inflation numbers. Why isn't gold moving? And it's like, well, because you're just thinking about it in US dollar terms. And mainly you hear that from Americans who only think about things in US dollar terms. But, I'm Canadian, so I always have thought in at least two currencies, and most of the world does, right? They think about their home currency and then relative to US dollars. So you're already thinking about the world that way. But the majority of commentary that we get comes from the United States. where they only think about things in terms of one currency, right? So it makes sense. But yes, outside of US dollars and rubles, gold's up in most every currency in the world. And the US dollar rally makes all the sense in the world. It's also become the most overcrowded trade in the world. And eventually that will lighten up. And when that rally rolls over, you have to wonder, where's the wealth going to go next? And why did it go to the US dollar? That may give you a hint of where it might go next. Well, it went to the US dollar for safe haven status, right? All the reasons that the gold bugs are like, why isn't gold moving? The world's on fire, inflation numbers, war, energy crisis. Gold hasn't performed. It's like, because the world trusts US dollars a little bit more. Because they trust US dollars a little bit more, that's where everybody went. But now you're in this frothy bubble, right? The US dollar trade's become a bubble. And so what's this, now it's no longer the safe haven. It's become pretty risky to be trapped in US dollars with too much of your wealth, because that rally will roll and you don't want to be the last one to sell. So people are going to start jumping ship, right? And where are they going to go? They're going to go somewhere where they can have a similar level of confidence as they had in that US dollar trade. They're going to look for safe haven status and stability. And there's only a few places you can go for that, right? And I think as a consequence, we're going to see a bit of a rotation in the equities market. People will go back to the equities market, maybe towards value generating, dividend paying, necessity creating companies, right? Utilities, energy, agriculture, hard commodities. I believe that's where a lot of money is going to get rotated into. I also believe a lot of that dough is going to go towards the gold sector. That's what I think.
Jay, thank you so much for your time. I really appreciate it. So my last question is, what is one message you'd like people to take away from our conversation?
Investing is a lifelong pursuit. And when I said earlier, the first question you should answer is, how much time do you have to invest in being an investor? Think about that over time. How much time do you have to invest in being an investor for like the next 10 years? Not how much time you have this week to be an investor, right? And just be patient, right? When you rush in, that's when mistakes are made. Fools rush in and people lose money. But results compound day after day, week after week, month after month, and year after year, and decade after decade. And that's when your life changes. But anybody can dream about hitting a home run, but don't chase that down exclusively. Think this through, think long term, be patient, stay with it. It's a skill like anything else. It takes time and practice and dedication, and eventually results compound.
Yeah, I think that's a great message to take away. So Jay, thanks again. So we mentioned your show, which is, I'd really recommend lots of people watching. It's on YouTube. Is there anywhere else people can find your work and what you do?
Well, we produce investment conferences. Our next one is in Vancouver, British Columbia on January 29th and 30th. Got about 120 keynote speakers, a lot of the names that you've seen on my show and many, many others. You can get tickets at cambridgehouse.com, and it's a blast. Last year, we hosted the former Prime Minister of Canada, Stephen Harper, and the former President of Mexico, Felipe Calderon. There was no shortage of macro narratives to discuss with those two. We've got a similar lineup this year. Lots of fun names to dig into all the chaos that's unfolding in the world and how to make sense of it. So cambridgehouse.com if you want to come to one of my events.
Yeah, you might have to start making them longer just because of all the stuff that needs to be talked about. It's getting to that stage. But yeah, also I'll put that in the description below. But thanks again.
Yeah, thank you.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.